Hey everyone, in this video I'm going to analyze Johnson & Johnson's financial statements to try and figure out if they're a good deal right now. If you're new to the channel, my name is Dan. I'm a business school professor focused on accounting and finance, and the purpose of this channel is to help you guys save and invest your money better. So if you're into that kind of thing, please hit that subscribe button, hit the like button. It helps me a lot. Johnson & Johnson is a healthcare giant, a member of the Dow Jones Industrial Average. They operate in three main segments. You've got consumer products, which you're probably familiar with, medical devices, and pharmaceuticals. So if we just use information from their 2019 annual report, we see that the pharmaceutical division accounted for about half of the company's sales. Of the remaining half, you can see it's largely medical devices, with about, I would say, a third of that other half coming from consumer products. Now, Johnson & Johnson has a remarkably stable business, and as a result of this, they've been able to maintain a dividend for many decades. If you look at this chart here, they have not only maintained, but have grown their dividend over the past 30 years. So you can see the dividend yield is a mere 2.91%, but consider that they're going to grow their dividend, you're going to end up having a yield on cost, which is going to be much higher. So I'm looking at the past 4 years of financial statement data, plus I have the trailing 12 months for 2020. So that would be 3 quarters of the year 2020 plus the last quarter of 2019. It does not make for a perfect comparison, but it's the best we can do at this point in time. So what you have here is a remarkably consistent company in terms of the amount of revenue they generate every year, and pretty much with their net income. We have a fluke here in 2017 with an abnormally high tax expense, leading to a very low net income that year. But other than that, we see a very steady stream of net income. We can do a vertical analysis where we divide every one of the financial statement numbers by revenue, so everything is a percent of revenue. As you can see, they have a pretty consistent gross profit of about 2/3 of revenue there, about 66% or so. And their net income margin is usually about 20%. Okay, let's look at liquidity and solvency for the company. They have a total liabilities to total assets ratio of about 62%, which is higher than some, but pretty normal for a mature company. The current ratio is a fairly healthy 1.48, and the quick ratio is above 1, so we're looking safe so far. And of course, they have substantial working capital here with about 18 billion. So Johnson & Johnson has a pretty impressive ROE at 28.4%. The source of that incredible profitability is composed of 3 components here with our DuPont analysis. Net income margin is 21%. So for every dollar of sales, they end up profiting 21 cents. Asset turnover is about 0.5. So for every dollar of assets in place, they're able to generate 51 cents of sales revenue. And we have the equity multiplier, how leveraged they are, which is 2.65. So when I look at that kind of profitability, I like it, and I like the sources of profitability. They're not highly dependent on their leverage to get profitability. Okay, so to figure out whether Johnson & Johnson is a good deal right now, I'm going to compare their share price to the intrinsic value per share estimated using a free cash flow to equity model. Now, free cash flows to equity are essentially a measure of the potential dividend the company could have paid shareholders. If we take all of these potential dividends and we discount them back to their present value at this time, we can come up with the true intrinsic value of the company. Now, this true value is true as long as all of our estimates are correct. So free cash flow to equity is a measure of the potential dividends the company could have paid. This includes not only the dividends they did pay, but any other profits that they chose to not pay out. One of the reasons I'm going to use this model rather than a dividend discount model is that there is quite a lot of value in share buybacks, which a lot of corporations are doing these days. If we look at Johnson & Johnson's payouts over the years, you see that a good chunk of it comes from stock buybacks and not actual dividends. So if you use the dividend discount model, you're likely to underestimate Johnson & Johnson's true value. Okay, so to make the model work, We need to know the free cash flow to equity next year, and then we need to estimate some type of growth rate that it will grow at over the next 5-year period. It's usually pretty hard to forecast after 5 years. So at that point, the company's not worth nothing at that point. It has some sort of terminal value. Now, to figure out that terminal value, we're just going to assume that whatever the free cash flow to equity is estimated to be at that point, we're going to divide it by the discount rate minus a perpetual growth rate. Perpetual growth rate just assumes this is a mature, steady state company growth rate, no abnormal growth. So people normally pick a low number, somewhere between 2 or 3%. The other inputs into the model include the discount rate and the growth rate during the next 5-year period. Now we can find an estimated growth rate. You can just go to Seeking Alpha and see what the consensus financial analyst estimated growth rate is. The discount rate is much more difficult to estimate, and so we're going to use a few different rates and see how the value changes. So what I have here is a matrix with different assumptions in it. I am going to assume the perpetual growth rate is 2.5% in all cases. Other than that, all I'm doing is changing up the numbers as far as the discount rate and the free cash flow to equity growth rate over the next 5 years. This is the most optimistic case. If we assume they can grow their free cash flow to equity at 6% and we assume a 6% discount rate, the fair value right now would be $264.18 per share. This is the most pessimistic case. If we have a 9% discount rate and 3% growth in free cash flow to equity, the company would only be worth $123 roughly per share. So you can see with the company currently trading close to $138, $139 per share at the time I make this video, it's going to be a good deal under all but the most pessimistic assumptions. Consider the most recent estimates we have over at seekingalpha.com. The earnings per share forward long-term growth rate, 3 to 5 years there, is about 5.83%. The free cash flow per share estimated growth rate is 5.6%. And they estimate that dividends per share are going to grow at 6.25%. Now, Johnson & Johnson is a very stable company with multiple business segments. Their beta is about 0.69 based on the past 5 years of data, and it's usually below 1. So for me, with the low interest rate environment here, it's hard for me to imagine a pessimistic scenario where I would give them an 8 or 9% discount rate. I think we're more in the top 2 rows here. And when you look at those rows, even at a 3% growth rate for earnings, this is still an excellent deal right now. Finally, I always like to look at insider trading. You can see here in the past 3 or even 12-month period, you don't have a lot of action. You only have a couple buys, and you have quite some sells, 19 selling. But when you look at the number of shares involved, it's really not substantial. With shares sold in the past 3 months, just about 16,000 shares by insiders. So I think here you kind of have a wash. There's no real big evidence that the stock is underpriced, but the insiders are also not revealing that it's substantially overpriced. So after running the numbers, if you ask me, Johnson & Johnson seems like a pretty good deal right now. It's got a pretty good margin of safety. It's not the kind of stock that's going to earn you 100% return in a year, but you're not going to go broke. It's a very safe company, and I like the dividend growth. Well, that's all I have for this video. If you liked it, please hit that like button. It helps me a lot. Thank you.